So I feel like I keep saying that the next panel that we'll have is probably the most important topic of the day. So the next panel we're going to have, I feel like, is going to be the most important topic of the day. They're looking at discussing funding outlook for the balance of 2023. And for any market participant, you know that this is a hot button issue going forward. So to facilitate this amazing conversation that we're about to have, we're joined by Michael Bodley from Blockworks. And for this panel, we have Zoe Cruz, who's the founder and CEO of I'm going to say Mania, but it's Manai. I apologize, Zoe. Founder and CEO of Manai Financial Group. Steve Cruz, who's the global head of asset management at Galaxy. Joe Miranda, global head of digital asset investing at Cambridge Associates. And Catherine Molnar, CIO of Fairfax County Police Officers Retirement System. So please welcome them all to the stage.
Not bad walk-on music. Hey everyone, it's good to see you. Thank you to iConnections for having all of us. I'm Michael Bodley, I write for Blockworks, and we've got a really, really good panel here. So I'm gonna let all of our panelists go down the line and just say a little more about themselves, what they do, why they care about crypto. Catherine?
Great. Well, thanks to iConnections for having us. First of all, I just want to say that my comments are off the record. I can get back to that if anybody needs to know why, but at any rate. So I represent about just slightly under a $2 billion public pension, and along with my colleague who's here today, our first two pension plans were, we believe, the first public pensions to have invested in this space. We've been invested since 2018. The majority of our exposure has been in venture capital, and so really a play on blockchain technology itself, and it's sized as a speculative venture capital investment. We think of it as technology. We do not think of it as a hedge to anything else that we're doing. We don't think of it as a currency. It is technology, really like an infrastructure play. More recently, we have had some more liquid token exposure, really kind of more in a long and short format. We remain very constructive on it, and again, think it's a high growth area.
Thanks.
Thank you.
Great. Good morning, everyone. Joe Miranda with Cambridge Associates. We manage about $550 billion for clients around the world. We invented the endowment model 50 years ago, this month or next month. And I've been working with clients in crypto since 2016, and I spend all my time doing manager research. And it doesn't matter what fund format. It could be venture, it could be a hedge fund, it could be long only, it could be a spot, doesn't matter. And then I also work with clients on their total portfolios, total crypto portfolios.
Hi everybody, my name is Steve Kurtz. You just heard our CEO, Mike Novogratz. I have two things to thank him for in life. One is offering me a job on September 11th of 2008 to go from Lehman Brothers to Fortress. And the second was teaching me about Bitcoin in 2017. So that was my start to crypto, and I think my general posture for the last 5 years has been, what if there are things that are good here, not what could go wrong? And I think if you approach it that way, you can start to see some of the possibility of the asset class. I lead the asset management business at Galaxy. We have a $2 billion asset manager that manages across passive all the way through to venture products. And we're happy to talk to you today about the environment.
I'm Zoe Cruz, and I am thrilled to be in this space. This space, in my view, is tokenization of value, trading around the world with the blessing of regulatory constructs is a very big deal. Disruptive technology does change the world. And so I'm all in on this space. Not just about technology. I think technology without the digital assets traveling with them is a database. Distributed ledger technology, it's a wonderful thing. But it's the two together that are revolutionary. I started as a foreign exchange trader at Morgan Stanley many, many years ago. And to show you how the world has changed, at that point in time, investment banks did not do FX. It was only the purview of the Citigroups, of the commercial banks in the world. And obviously, investment banks grew to dominate the space. That revolution was finance globalizing. I think this is as big as ever, if not bigger than finance globalizing. So I set up a business called Manai Financial Group. Manai is a bridge in Wales that is a suspension bridge that was built in 1830 that bridges old and new. And so our company is a B2B company. It does build infrastructure. It is an asset management company with diversified products. And it also has a market-making, liquidity-providing division in it as well.
Thank you all. I can't find a single thing I disagree with in any of that, which can be a little unusual on these panels, so well said. My own 2 cents, I like to kind of sit here and shut up on these panels generally and let people who know more than me talk as much as possible. So we're going to try and keep this conversational, we're going to try and keep it lively and that kind of thing. Contrary to what you heard, crypto isn't dead. It's actually a time of abundant opportunity right now. If you look at the last cycle, right, which kind of came out in 2018, down, up, most of you probably know that particular story, no one knew what an NFT was, right? People's 69.3 million tokenized NFT was a kind of a pipe dream. People knew what Bitcoin and Ethereum were, but they didn't really take off. So I think the way we'd want to frame this is not about what happened, right? We all know that story. We're all sick of talking about that story, but to make it as much forward-looking as possible and talk about opportunities and their abundant opportunities. So with that being said, Zoe, do you want to give a quick overview of the regulatory environment right now, the macro tailwinds? I mean, why to you is this an opportunistic time, and where do you see things going this year?
Yeah. For 2 reasons. One is I never viewed, I was at Morgan Stanley, which is a very well-regulated institution globally. I never viewed regulators as your enemy. So I think regulatory imperatives that we all as an industry listen to will help us grow this industry and bring more adults in the room. So I think that regulators all over the world, whether you're in Singapore, or in France, or in the UK, or in the US, the SEC, the OCC, the CFTC. I mean, the US is a bit complex, to state the obvious. But they're all saying one thing. Bitcoin to Bitcoin, knock your socks off. The fiat on and off ramps, we're going to regulate you the way we regulate Citigroup. And if you're a company that listened to that 4 years ago, you would have thrived and will continue to thrive. So we have in Menai more compliance officers than we have traders. And I intend to keep it that way. In terms, so that is, it's a, what's the word, maybe revolutionary thought. I think that's a chance for us as an industry to grow with the regulators along with us. The other very important helping, you call it tailwind, I guess that's a good thing. Yeah, just I want to make sure my English is right. My macro view on the world is highly distressing. The 60-40 portfolio, 40-60 portfolio that we all grew up in is in deep trouble. You don't need to do complex math to figure that out. And so for me, when you look at the opportunity cost of money, after 2008, after the world imploded, you could have bought B of A stock at 50 cents of its book value. That was an opportunity cost not to put it in risky things. Clearly, the opportunity cost of your money says that 0 allocation into this space is the wrong answer. More than 3% or 5% is the wrong answer, because it is nascent. It's full of risk, not just market risk, but operational risk as well. And so my macro view of the world, actually, and a lot of the invitations from our future clients come because they want my opinion on the 60-40. I'll give you a statistic for last year, which has never happened in the recent multi-decade in markets. Last year, you lost 19% S&P 500, 31% give or take on NASDAQ, and 34% in 20-year US Treasury bonds. You never, and never is a big word, lost money on both your stock and bond portfolio by hundreds of basis points. So the alternative of this risky investment where you can still lose all your money in exchange for 100x, it's irrational not to be in it.
Thank you. So I agree. 0 allocation is the wrong answer. 0 interest is the wrong answer. You're going to be kicking yourself in the whatever 20 years from now if you haven't put whatever makes sense to you, in my opinion. In that kind of context, VC valuations are way down, right? Spot prices are way down. Leverage has been flushed out of the system. Derivatives are a little easier to trade, depending on who you ask. If you all could just give a kind of quick overview, what's the right answer to you right now?
Sure, from an allocation into crypto perspective. Sure. Look, I think what you started with, which is that NFTs weren't even known in the last bear cycle, is an important starting point. It's not just NFTs. Out of this last bull and bear cycle, you have NFTs, stablecoins, DeFi, a layer 2 ecosystem. Previously, it was just Bitcoin and Ethereum. So I think for a lot of allocators, even just the majors, there's not core Bitcoin and Ethereum. Like starting there and not trying to do too much with the space is a good start. The other thing that I think fundamentally different about now than the last bear cycle is it was much bigger, and that makes it more difficult to work with, and for the regulators, they pay more attention, obviously, but it also expands the opportunity set. So in the first bear cycle of crypto in 2018, not the first that I saw, you weren't able to do something like a secondaries fund or opportunity. What we're seeing now, after $57 billion of capital has been committed to venture funds in the space since 2017, and $85 billion of venture deal investing has been done at the early and middle stages, on the back of this, you have a real overhang. And that's a big enough soup to be able to really step in and buy really good high-quality assets at a discount. The companies that are of the future of the digital rails that Zoe just talked about, not buying distressed assets that may go to zero. That's a very different framing and starting point for crypto as an allocator than it was 3 or 4 years ago.
Thoughts, comments? Anyone want to chime in?
Yeah, I think, so I like your comment about secondary opportunity, but what this market is still so new, though, that there is no intermediary, just everybody know, there is no intermediary. You actually get a call from a venture fund saying, hey, we've got an LP who's going to welch on a commitment. Do you want to talk about taking it over? So that is how nascent the opportunity set is, but you would obviously expect higher return potential because there is no intermediary and there is no efficient pricing mechanism. So it really is just a one-on-one negotiation with the fund to take over basically something that somebody is going to welch on. So that is one of the more fascinating things that we still have yet to see, like all of the intermediaries that you would typically see in traditional venture. Somebody would step in the middle and say, hey, I've got somebody that is in distress. They need to unload some venture interests. And then they would go out to like all the natural buyers. But actually, right now, it's the funds that are basically just calling around saying, hey, you're already in the fund, do you want some more? And that's, but it's a great sign that we didn't even have that the last crypto winter. There was none of that. And so this is actually a big step forward for us.
But in 2022, the centralized companies in crypto that got all the headlines did the wrong things. I think the role of Galaxy and other centralized companies in crypto is to be that intermediary. And there are not many of them, but there are a couple, and that's also different than 3 years ago. Center of gravity for some of that flow.
You're saying that we're going to be negotiating for a long time ago.
We might be talking about this, yeah.
The thing about this, actually, in terms of, I don't disagree that this is an opportunity, but in my view, what the industry is suffering from a lot of side stories that take attention from the story, that this technology will change business models, not just finance. And so, again, from my macro view of the world, the private equity and VC world hasn't finished mark-to-market yet. And so if that world hasn't finished mark-to-market yet, the cost of capital no longer being zero, so capital will not be plentiful. I don't know that, without, you asked the question, what is the biggest opportunity? For me, the biggest opportunity is finding a diversified portfolio of digital assets that the portfolio manager uses research, deep research, on who are the coders, what is the governance, what is the use case, not it's going up because it's bid kind of analysis, and put it away. That's the biggest opportunity.
Thank God for lockups. In general, thank God for lockups. It's always been my personal view that crypto lockups, whether we're talking liquid hedge, VC, kind of PE, but it's kind of too early for PE to exist. It depends who you ask. Should be longer. I think it's better for allocators. Might be a contrarian take. I think it's better for managers. It's kind of all about your time horizon and how you zoom out. So, Catherine, I'm wondering if you can speak to, from an institutional allocator perspective, what has changed from the fourth quarter? What opportunity set are you looking for? And I know there's a big distress opportunity right now, right? Like TradFi firms coming in droves.
Yeah, absolutely. So thank you. So for us, despite the crypto winter that all of us, endured last year, we are absolutely still up on these investments. They've done that well, and they did very well very quickly. So even with some of the write-downs last year, we are very much still overweight this part of our portfolio. And as you all would know, I'm sure on the stage, where we've continued to get a lot of capital calls from managers, and we've continued to deploy, right? So we definitely have several managers that have a lot of dry powder, and so this is a great environment for them to obviously be deploying capital. We hope that we could even just re-up with existing managers, but this part of our portfolio is very much still overweight. You're absolutely right. I think that people, allocators like myself, are going to have an opportunity to invest in this space, and it might actually even be through like a classic distressed manager who isn't a crypto native organization, but maybe a classic distressed manager who now wants to get exposure to some of the names in this area, and then to Steve's point, secondary transactions as well. So I think there's plenty of spaces to invest if you're willing to do it. I don't know if what happened last year will set the allocator community further back in terms of maybe entering the space. It would be great if it sped it up, because these are really good entry levels and some really interesting things going on. Time will tell. I don't know in terms of kind of specific to lessons learned. We invest through external managers, and we didn't have any exposure, for example, to the Terra Luna debacle last summer. But having said that, I think I'm not particularly sanguine on algorithmic, altcoins or stablecoins that aren't backed by actual reserves that can be audited. So, perhaps that's a lesson learned for the industry. We also didn't have any exposure to FTX, thankfully, and we have several managers who looked at it as an investment, as a portfolio company, and passed on it. In one case, we have a manager that passed on them 6 different times, like six different financing rounds, and passed on them every time. So didn't have exposure there, but I think that there certainly will be lessons learned from that case. And one of the things that people have talked about is not the manager shouldn't be parking money on an exchange for an extended period of time, and should be very proactively kind of managing that margin, that collateral, with that exchange. So I think that there will be some changes that maybe we'll all see. But in general, we have a long-term view, I think, very similar probably to everyone on stage, and I absolutely echo some of Zoe's comments that we just think it's an area that's poised for huge growth, and we think that blockchain technology is not particularly new, but we think it's going to be really pervasive, if you will. And I believe I heard Mike Novogratz talk about eventually that like your medical history will be on a blockchain, and your driver's license and your marriage license, and we are of the opinion that virtually every asset will ultimately be tokenized. So every equity, every bond, mortgage, your house, right? And so fractional ownership possibilities. And there's just so many opportunities around the infrastructure of everything that I just said, and that's what we're trying to.
Thank you. It's already happening, right? If you look at tokenized NFT mortgages, that just blows my mind. And I write about crypto, so take it with an according grain of salt, please. I used to write about hedge funds, so I have more in common with some of you in the room as a result of that. But Catherine, you're exactly right. NFT mortgages, tokenization that's getting pick up from traditional securitization allocators, right? It's kind of a lot of this, in my view, is making LPs, institutional LPs who historically have allocated to any kind of TradFi, understand crypto. And that's an easier said than done for many reasons. It's something that's kind of evolving all the time. It's a moving target for sure. I do hope all of us in crypto have learned our lesson. I wasn't convinced of that with the first 2 black swans this year, but I think now leverage is flushing out the system and we're actually getting somewhere. Joe, what's the opportunity set right now for both LPs and GPs, and how has that changed from fourth quarter or whatever you want?
Yeah, so night and day. I think for a GP that's trying to raise right now, and there are some out there, my advice is wait. General fundraising environment is bad. Crypto is really bad, and it has more to do with total portfolios being down so much. That slotting in a new manager is a really heavy lift because they have to re-up to their high conviction names and they have to rebalance their total portfolio, which is a challenge when everything is down. Managers that are trying to raise now, my advice is wait until really the 3rd and 4th quarters. Once we have the June 30 marks in on privates, folks will have a much stronger idea of how much illiquidity they can handle. And even if institutions are investing in liquid funds, I still encourage them to think of them as illiquid investments because these are multi-year opportunities. Like anybody who thinks that crypto is something you can trade in and out of is going to lose a lot of money really fast in general. And so the institutional advice is, while you can deploy capital now, the goal is to deploy capital throughout the crypto winter. And to take a step back, crypto winters are really the only time you can actually make money in crypto. If you're deploying capital during the bull market, you are going to lose money. We have like an 80% standard deviation. Our market cycles are maybe 2 to 3 years. And at some point, after you've invested at the top of the market, you're going to be looking at like a minus 50, which is not going to be happy times for the investment committee. But
I can speak to that personally, by the way.
But if you deploy capital in the crypto winter, Catherine did. I have a client that started in 2017, actually. We started looking in 2016, couldn't find anything. In 2017, so we went through 2 crypto winters. That client deployed less than 2% of their billion-plus portfolio in 2018, 2019, and the first part of 2020. At one point, it grew to 14% of the total portfolio. That was scary. And it's now down to about 6 or 7. So we're still up 3x or over 3x because we deployed in the last crypto winter, and we deployed nothing in the last bull market. And so if you're an institution, you should be thinking about deploying in the winters and then holding throughout the bull market and waiting for opportunities to take profits.
I think there's a couple buckets, and I agree the second half is going to be better than the first half, but you either allocate it early, in which case you're either studying this, rationalizing it, or experiencing pain. Many who were getting educated in the last cycle only dipped a toe or didn't quite pull the trigger. That's the group of investors that has the ability to be opportunistic right now. It's a small group, but it's 5 or 10% of the market. There's a group that's been educated but is skeptical, that are sitting back and waiting. And then there's some subset that just says, you know what, we're not even going to look at this space. So I think really understanding who you're talking to and where their portfolio is, and sizing and layering is a very important concept as well, I would echo that.
So there's a crypto idiom phrase, some people might call it a cliche, I wouldn't blame them, build in a bear market, right? And it sounds like both of you are saying 100%. It's true. Yeah. Agree, disagree, anyone feel free.
I agree 100%. And I would actually say the opportunity vis-a-vis, again, your traditional portfolio, what I say, allocate 2 to 3% on this, give it to the adults in the room where you take 0 operational risk. Market risk is a very different thing. Operational risk, it's permanent loss. You don't come back from that. So give it to the adults, whoever that they may be, and focus on 98% of your portfolio that's still in deep trouble. And the reason I feel the opportunity to allocate to this space is great is if you look at the correlation, all risk assets in crisis go to 1. If you look at data, it's starting to decouple because fiat currencies are being debased. If you look at the Deutschmark and the Weimar Republic, you'll see numbers that are much smaller than now, where the US government has $31 trillion worth of debt, raising another $1.5 trillion every 12 months, whose interest costs are going up, not down. So this is the time to invest. And I would say, actually, the bigger opportunities in the liquid asset class, because it is liquid, but you should put it away.
But if you're a crypto company, the reason to build is not just because you should build during a bear market. The reason is that the top 10 asset managers on the planet they have tokenization teams. They're working on their strategies for when they can ramp up. The future competitive landscape, and that happens quickly in crypto. We're talking 1 or 2 years, not 3 or 4 years. Comes very fast, and the TradFi players are going to be the competitors for the next one. So we're trying to be on our front foot in a bear market, launching strategies, making acquisitions, but that's not because it's just a bear market. It's because the market is changing fundamentally in terms of the future bull cycle.
Crypto's a lot like dog years, right? I mean, whatever it is, 7 for 1, 9 for 1. I mean, seriously, the rate of change and acceleration and the lack of sleep we all get, I'm sure a lot of you people can relate, all sort of plays into that. And I think that sort of related to what you all are just saying and kind of in some previously, there's a big educational piece to this, right? There's a huge due diligence piece to this. There's a totally different fundamental question set if you're an allocator and you haven't allocated the crypto before, or you have, but you're kind of ramping it up, whatever. We're starting with the really simple questions, right? If you invest in an LSE stock picking fund, right? Goldman's going to custody those assets, JP Morgan's going to custody those assets, cash, whatever, FDIC insured, taken care of. In crypto, it's like, what's a custodian? what do you mean? Who's holding my money? What's a multi-signature wallet? There are all these huge questions. So where are we right now in terms of that due diligence, and how has that changed to you all?
Well, it's evolving very fast. We learn something new, not every day, but every week. We're like, oh, need to change it, need something, have a new data point that changes some thinking. Of course, everyone's waiting for the regulatory situation to resolve itself, which will add another layer that we have to think about, because there'll be some funds that perhaps you're like, oh, well, you might want to rethink your strategy a little bit given the regulatory outlook or regulatory environment. But diligence is still a constantly evolving process. There are whole new streams of diligence that are possible with crypto that aren't available in other asset classes, which makes it really difficult for somebody coming from TradFi to diligence a crypto fund. Not just simply the tech is extraordinarily complicated and the nomenclature, but the personal connections and the types of interviews you conduct are much deeper and much longer. And you're talking to people, usually engineers, who have no filters, and so you learn a great deal about a lot of different things.
It's true.
And then, of course, you have things like crypto Twitter and all of their social media footprint that you follow that would ordinarily not be something you would think about in traditional DDs. So always evolving.
But we've also come a long way. I mean, we treated the service providers like clients the first few years. Just to get an auditor was difficult 4 years ago, and literally now, I mean, Boney's coming in with crypto custody and banking services, BlackRock plugging into Aladdin. I mean, Fidelity to brokerage accounts. It's so different, the raw material.
The examples never end. That's what's really cool. Yeah. Those examples you're talking about never end, and it goes back to the rate.
But they don't get the headlines that all of the
exactly.
negative things get. Right? But they're real, right? And they're not going anywhere. And so that's a fundamental difference.
Agreed.
Yeah.
Agreed. All right, we've got a very scant amount of time left. I, for one, am determined to end a panel on time. We're going to end with something a little bit fun. A few seconds each. Hottest take, most contrarian take in all of crypto right now. Whoever wants to go first.
A few seconds?
No.
It's over. Ironically, I would say my most contrary view is not in crypto, but it relates why you should allocate to crypto. Is I think that the two huge assumptions markets around the world are making are terminal interest rates are going to stay at 2.5%, 3.5%, that inflation is going to crest, which actually in Europe is 10.5%. The rates are 2.5%. Even if it crests, it ain't going down to 2%, as they say in Peoria. So I think that is a huge assumption. Powell is not going to stop tightening unless unemployment goes to 5%. He doesn't care about where the stock market is. And the other big assumption for all you asset allocators that manage hundreds of billions of dollars, liquid asset classes are in fact liquid. So when you change your mind, $1 trillion of it can go and hit the bid. UK gilts, you lost 20% of your money in 3 business days. Annualize that. That wasn't a few seconds, but anyway, that's my contrarian view.
That's all right.
I'll take a positive view on regulatory. I think that's a very non-consensus view. I think the U.S. regulators are going to wake up to the fact that crypto is the tip of the spear to build the digital rails for digital dollars to fight with digital renminbi, and they're going to understand that that's the most important thing, even if they don't like crypto, and they're going to find a way to work together on stablecoin legislation and not do as bad of a job as the crypto community is fearing. Yeah.
All right, real brief. I think most folks are expecting DeFi to just get slammed by regulatory intervention. And so if I was going to be a contrarian, I would expect something really interesting and positive to come out of DeFi once the regulatory environment's clear.
Like that. Catherine?
I guess just maybe on this buying distressed assets and something we're not going to be doing it because we have plenty of exposure. But for those who don't, I mean, I think pretty interesting. I don't even consider that to be contrarian. I think that we should all be wanting to do that. So anyway.
Thank you all very much for listening. Thank you to the panelists. I learned a lot as usual. Hope you did too.
Thanks.